Really, there was a problem which started in September where funding just stopped for everybody. Funding costs went up. However, it's been 9 months since that day. So 2 or 3 things have happened is that RBI has actually infused quite a bit of liquidity since then. So if you look at the spreads over GSEC, etc., for the better run NBFCs or where market trusts the NBFCs, actually spreads have gone back to levels which existed in September. So there are certain players which are finding it tough to get funding, especially longer tenure funding. But for a large chunk of the people, they're actually getting funding. And you can look at the equity markets also. Equity market is differentiating between good and bad or weaker NBFCs. The way we think about it is that the total NBFC book in India, NBFC HFC book is about very roughly 25 trillion rupees. Of that, roughly 65 to 70% is what we call long vintage or strong parentage NBFCs. They're fine.
Yeah.
The problem is with the residual space where funding is a constraint. Not everything is finding it difficult, but generally funding is a constraint for them. And it will take time for that to be sorted out because they used to grow very aggressively. Now it's tough for them to grow. Yes. When you stop growing, you see some asset quality issues because in banking or financial lending, that's how it works. So they need to get out of this cycle. So I think it will take some time for them to get out of the problems that they are in.
So in couple of months, what's going to be the face of the sector? You think that the stronger ones will become stronger, like you said, and the weaker ones will be completely washed out?
I think stronger ones will keep becoming stronger. I don't know whether wash out, what do you mean by wash out? I think, let me put it this way, the weaker ones will keep getting weaker. And I don't think you will see a resolution in 2 months. I think it will take a longer time because entities just don't. It takes time for them to just keep getting weaker and weaker and weaker. So I think that the best way to look at it would be that the strong guys, the big guys versus the weaker guys, the divergence is just going to become exponentially large.
Okay. So the better ones, in terms of valuations as well, so you think that they might get even more expensive from here on? And in that perspective, do you think that they might see continuous buying from here on as well?
I mean, if they're delivering earnings, so there are 2 things. One is if there's an investor base who's looking at these stocks and they're like, okay, I can only buy these 9-10 stocks in the financial services space which are big and doing well, then obviously that will cause multiples to move up. So in fact, one of our views is that I think multiples for Indian financials, for the entities which people like, will move up simply because one is the weaker entities are not doing well, but more importantly from macro perspective, global rates are going down. You look at Fed futures, you look at oil prices, that's kind of come off, and you look at Indian interest rates, that's come off. So all those things are good for multiples. Yes, and generally all those things are good for a reflation trade, which is financials, but the problem in Indian financials is that a large chunk of the financials is something that investors don't want to own. So more and more of the money will probably move towards the same big, I don't know whether it's 5, 10, 15 names. So it varies from investors to investor.
Coming to the banking space, so in the latest report that you've put out, you see about 30 to 50% upside for some of the large banks and about 25% core PPOP growth. So where is this growth going to come from and what is the rationale behind your write-up?
Market share gain. Because what's happening is that loan growth in India is running at 11 to 12%. So I'm not saying that loan growth will go from 11, 12 to 18, 19 because unlikely, unless state-owned banks start growing. So if you have loan growth of 11 to 12% with a large chunk of the system just not able to lend because state-owned banks do not have the capital and these NBFCs or smallest private bank which is under pressure, they can't lend, they don't have the capital to lend. So the big guys can actually just take away share. So our view is that the asset growth for them will be between 15 and 25, depending on the name we are talking about. And margins structurally should be on an uptrend because you can see the lending spreads moving up because if investors, there are banks which are not lending, spreads are moving up. And second is that as bad loan book reduces, as a percentage of total margins also expand. So they're seeing, I would expect, I mean, depending on the name, we are talking about 20 to 25% revenue growth, and costs are not going to grow by more than 15, 14%. So net, you end up with a pre-provision earnings growth of 25%, depending on, again, name, 22 to 25. I mean, there's literally nothing else in the region which is giving you that kind of pre-provision profit growth. So as I said, it's going to be, the big become bigger, both in the bank space and the NBFC space, and the weak will just keep getting weaker.
Okay.
Unless the break point or the turning inflection point could be if the economy starts just going ripping, which I don't think is the case right now.
Okay. And you think that with the GDP growth rate that we saw of about 5.8%, for these, it's going to be possible for these banks to deliver this kind of earnings growth?
So that's what I'm not saying the system as a whole will give you that earnings growth. System as a whole will give you much weaker pre-provision profit growth.
Okay.
But for
It's
the big
going to
guys,
come to the bigger guys.
So there's some which is system growth. So if the system is growing at 11 to 12, you can say that they will grow their loan book at 11 to 12 just in line with system. But then you have another 3-4%, which means that the rest, because they are big and they're growing faster than the system, which means the rest will not grow at all.
Talking about the NPA cycle, most of the experts in the market are of the opinion that the worst is behind us. But is that really the case? Because in last couple of years, every few years down the line, we see some NPAs emerging. Yeah. Right now also, we have so many names, ADAG, DHFL, etc., SL Group. All these names have emerged in last couple of months. So what's a guarantee that,
No, there's no guarantee. Obviously, there's no guarantee. The only thing is what has happened is that the big lumpy exposures have been taken care of. And because when the government recapitalized the state-owned banks 2 years back, 2 years and 1 year back, they gave them enough capital to be able to recognize bad loans, make provisions on it and move ahead. So once they did that, I think they are broadly okay. So a lot of the old loans have been taken out. Obviously, you'll keep seeing new additions. Right. The question is, how many new? Because what we were seeing in the last 5 years was the additions as a percentage of loan book every year was a dramatic number. And for some of the banks, it was running at 4 to 5% of loan book.
Yeah.
I don't think you're going to see that. Will there be new NPLs? Absolutely. It's a banking system.
Yeah.
So, that's what I was talking to. Like, you're seeing new names come up, but most of those are mid-cap except for the names that you talked about. So credit costs will remain elevated. But they're not going to be 300, 400 basis points of loans which was running at, these banks were running with. Maybe it's 100, 150. That's still a big number. So we're not saying there will be no NPLs. There will be NPLs, but it will not be of the same magnitude that we saw in the last 3 years.
Okay. In terms of sectoral exposures, so you think that there is a huge risk coming in from some sectors, let's say agri or SMEs. Even in your note, you've mentioned that, the credit actually needs to start flowing to the MSMEs, because if all the banks start focusing on the, quality papers, who lends to the BBB minus below?
That's a big risk in my view. So what can cause another NPL cycle? Again, I don't think it will be of the same magnitude as what we saw, but an NPL cycle, a proper NPL cycle would be the fact that nobody is lending to BBB and below.
Yeah.
Like all the guys who have capital are saying, okay, I want to lend in retail and I want to lend to AA, AA, AAA. So if the system doesn't lend to BBB and BB, how do you have an economic growth without that? So which means that you can have some problems there. So you need to have credit flowing to the lower rated corporates. Like if I start a company today, it won't be a AAA, it will be a BBB or whatever. So you need to be able to fund BBB and below. Otherwise it will be challenging. Because there is part of the economy which is getting credit, the part of the economy which is not getting credit.
Yeah. So SME guys, because they are the bottom of the ladder people. So if that's SME lending is a concern, so you think that at some point in time, even retail book may become a concern for
possible. So I mean, again, India has been going through a very strong retail cycle for quite some time.
Yeah.
So I think within retail also, what you have to think about is like everybody looks at retail and say, unsecured. Everybody's unsecured is not the same.
Yeah.
Like the big banks, when they are giving unsecured loans, they're giving it to their own depositors. The behavior is known. But the new NBFC, etc., the new guy on the block, they have they don't have data. So their funding cost is significantly higher than the big bank. So if they are lending, they're obviously going down the economic strata and lending to people. Again, it may be okay, but the losses there will be higher than the losses at the big banks. So I think if the economy, if you see retail NPLs, I think it will again be at the kind of new generation NBFCs, etc., which is where you will see NPLs. We are not building in a retail loan cycle. I think that's 2 years away, but I think there will be a massive divergence in terms of who gets hit and who doesn't get hit.
Okay.
So I think the banks and the big guys will be fine. I don't think they have taken risk in retail lending.
Okay, so at least 2 years from now.
Yeah, and small. I think it will be more in the smaller guys.
Okay. So what are you advising your clients currently? What are your top bets at the
Just
moment?
own the big banks.
Big banks.
Big banks
Okay.
and big NBFC also we like, but big banks. Like the top 3-4 big banks, I think they've done well in the last 1 year. We have been saying that for the last year. But I think the divergence will just continue.
All right, Anil. On that note, I'll wrap up this interview. Thank you so much for joining
Thanks so
us.
much. Thank you.